How do you decide you have the right idea? The market has to tell you. Yeah, your mom won't tell you, your friend won't tell you. And your investors, despite their best intentions and support, still can't tell you. You could be very successful at raising, but that is not a measure of success. Your customers need to use your product and pay you for it.
Hello, this is Shawn, Budde of Ensemble X, and this is the Ensemble X Exchange podcast. My guest today is Manoj Pinna. He's an entrepreneur, investor, and credit industry veteran. Until recently, he was the CEO and co-founder of Pebble Health, a venture-backed startup that used AI to create employee benefits for small businesses. Prior to that, Manoj lived and worked in Sao Paulo, Brazil, as part of the founding team at Nubank, where he built and led functions spanning credit risk, product strategy, data, and collections. Earlier in his career, Manoj held various roles at Capital One and at Zest AI, including as head of modeling. He earned his degree in electrical engineering from the Indian Institute of Technology in Madras, and today Manoj is a single father working on his next venture combining fintech and AI. Welcome, Manoj.
Nice to be here, Shawn.
So Manoj, we worked together at Zest, and one of the things I really liked at Zest AI is that we had a family lunch, in essence, every day. It was catered. It was very nice, maybe a little too nice. At the end of lunch, about half the crowd, it seemed, would head into the ping pong room. And I wasn't in there very often, I'll admit. Yeah, can you tell me about what that did on the culture and how you guys I believe you built a ranking system and everything.
Yeah. So we did have a ping pong room at Zest. And so we had 8 lunches at Zest, as you mentioned, the best office lunches I've ever had. And after that, most people adjourned to the ping pong room. Some of Zest was a very data focused company, heavily modeling based, as you remember. And the people took that seriously everywhere. So we had an internal website that computed ELO rankings for all players at the company. And anytime two people played, they had to enter their game and the results into the system, so everybody else's ranks and scores could be recalculated. And if you have seen the movie Social Network, ELO ranking is the same formula that Mark Zuckerberg uses in this movie for his website Face Mash that got him in trouble. But it's also the same formula that they use for MMA and chess and a bunch of other places. So we did that quite a bit, and it was a good cultural thing. So the group lunches helped, somewhat distributed team. Shawn, you were living in Chicago, although you spent every week in LA. Just great for bonding, trash talk during the games, and then go back to work and be a little more formal again.
And so you took that with you to Nubank, is that right?
Yeah, I think, we had a ping pong table in our first office. Then we ran out of space. People were sitting practically on top of each other. So we had to pack it, move it somewhere else. Did the exact same thing in our second office. And then finally, in our third office, we had a dedicated game room. And I think the company is still in that office. So that was fun. I played a whole lot less there, by the way. When you take candidates through the office and they see a ping pong table, it's always a good thing to sell the company.
Yeah. And then tell me about the new Olympics.
I don't want to get in trouble again. So in 2016, when we were living in Brazil, the Summer Olympics happened in Rio. And because this was going on, we decided to hold the tournament for several games in the office, one of which was ping pong. And when I cleared the semifinals, somebody took a video of it, posted it on the company Twitter, and said, so Manoj is playing with somebody else. So I got a silver in this, by the way, I have to brag. I was only beaten by a former professional footballer. So when this thing got posted, the very next morning, so you have to imagine that we were in Brazil, which means it's already late evening in Europe. From the Olympic, the IOC's headquarters, we got an overnight legal notice informing us that the name Olympics is owned by them, and we are violating their trademark by calling these internal company games New Olympics, and we had to cease and desist right away, or bad things would happen to us.
That's spectacular. I can only imagine how many of those letters are sending out.
New games.
New games. All right, that's safer.
Part of the reason I think they didn't like it is new actually means nude. So new bank has this connotation of it's a new bank, but also both in Portuguese and Spanish, it's also meant to convey clarity, clearness, etc. And so the word also means nude. So it sounds like nude Olympics to them, maybe.
That's probably not a plus. All right, well, let's talk about that. You worked at Capital One, obviously a very large established organization when you were there. Zest was, I'm going to say, 50 to 60 people when you joined there. And then you kind of jumped in two directions. You went to an earlier stage and you went to a different country, A very different country, I'll say. Yeah, can you talk about kind of what made you take that leap, in two directions at one time?
Yeah, yeah. So, I mean, Zest was much smaller when I joined there. So, I was interested in early stage companies, but still, I believe Series A. So, yeah, at some point, Zest had to deal with a pivot regularly induced. And so, that was a good time for me to check in and try to figure out what I wanted to do with my career and my time. So, I put a couple of feelers out there. I ran into this company based in Sao Paulo. It wasn't called New Bank then, it was called EO2. So I got chatting with David Velez, founder CEO, and Ed, the co-founder CTO. I heard enough interesting things from them that I wanted to just go down to Brazil, see what this is all about. So I flew down to Brazil, talk to the team and what their vision is. But also, as part of it, I reached out through my network and talked to a bunch of people in just Brazilian banking and financial services. The interesting thing about Brazil is almost all senior leadership at Brazilian bank, and maybe this is true even in traditional US banks, they've all been to B school in the US. So if you shake your network hard here, you will run into a few people there. So I flew down to Brazil. I talked to David, Ed, and by this time Christina was also on the team, and just like traveled around a bit to see what's going on here. And so the thing that came together for me was first, I've never really thought about Brazil much before, but it's a large country. It has 200 million people at the time. It's the ninth largest GDP out there. So it has some real economic heft if you do things right. The unit level economics were crazy for any financial services product you could think about. We are talking people with good credit in Brazil paying 20% per month in interest rates while paying an annual fee to have access to any sort of credit products like credit cards. And these products are useful because you need them to buy a flight ticket online or you show up at a ticket counter for an airline. Those are the two options. You can't do it with debit cards in Brazil. You couldn't. Uber is making inroads. Using an Uber is a lot easier with a credit card than anything else. So these are useful products that were very, very expensive, which meant between the large economy and this, if you figure out what you're doing, you can use your product economics to pay for your growth. As opposed to in the US, you still needed to raise a lot of capital to pay for your growth because the market was fairly saturated and incumbents were decent. And then there was the last piece, which is, yeah, when I reached out to all these people and talked to them and asked them basic questions like, how do you make decisions? Who gets a credit card? Who doesn't get a credit card? How do you spend your marketing budget? I was pretty unimpressed by the state of the art back then. And like these were impressive people, but what they were doing with their products was not that impressive. And particularly with my experience applying better data and technology to an underserved market, I felt like we could do the same thing there in Brazil. So when those three things came together, it was a relatively easy decision to at least try it out.
Got it. When you joined, like how big was the company? Yeah, you referenced the first offices and how those got outgrown, but yeah, how many people were there on day one, and what were the biggest challenges at that point?
Yeah, so I believe it took a little bit of time for the visa paperwork to be done. So initially I was a visiting professor, let's say, not on the payroll, not getting paid. So I believe when I accepted, we were 8 people. When I showed up in the office, I think we were 13 people. Yeah, over time, the company has, I don't know, 6,000 or 7,000 people now as employees and obviously outsourced functions. Yeah.
Yeah, you were in a real office at that point when you joined?
So here's what was happening. So we had Ed, our CTO and co-founder, living in a house in this place called Brooklyn in Sao Paulo. Very, very residential, by the way. Everything else on the block was a home, and this was also a single family home. So Ed lived there, and one of our first engineers, it's the first time he was living away from home in Brazil. So it was even a challenge for him to find a home. So he was also living there. And so they wrapped up their mattresses during the day, and that was our office. And then over time, it got to the point where they just had to wake up earlier and earlier and roll up their mattresses and put them away. Yeah,
Yeah, I mean, that's kind of the way you're supposed to start, right?
I guess. Yeah, we didn't have a garage.
Exactly. That's the modern garage. So, one of the things I remember you telling me about is, I believe, slicing the sausage was your phrase.
Salami. Yeah.
Salami, slicing the salami. Yeah, tell me about that.
Yeah, so yeah, I end up in Brazil. They work at a breakneck speed to build the infrastructure so we can issue at least one card. So we could get grandfathered in as a card issuer
Oh, interesting.
because of some regulatory change that was about to happen. So we do that. We go tie up with some local payment processor and authorizer. You've seen this thing before at Capital One, where if you're issuing credit cards, you need something that is sitting there authorizing transactions real time while somebody is waiting at the point of sale. And so in 1 second, you need to make all your fraud decisions, all your credit decisions for that authorization. So we hired a local payment processor for that. And it was immediately clear to us that could not scale over the long term for the kind of data driven, mass customized, product driven company that we wanted to build. We haven't yet issued a single card to a real customer. We only have cards for people in the office and our spouses and a couple of friends. And we were already at a fork in the road. And so the big fork was we can't build the kind of company we want to build if we use this existing payment processor. We could hope they would change or update their systems for us. But it is hard for them to do it when you have a handful of cards as customers and they have other customers. Or we need to go build that thing ourselves because none of the existing incumbents in that space wanted to talk to a small Brazilian tech startup. So the question is, what do you do? Do you build for the long term and start with good foundations, or do you actually validate your market hypothesis? Because until you build it and customers use it, it's just a pie in the sky, right? You could think data and technology will get you there, but maybe people don't care and they care about the color of the card more than anything else. My answer and there were like very strong opinions about this both ways. My solution was let's just slice the salami because anything else means I'm just going to go on a motorcycle vacation in South America and come back, see you in 18 months. And if the company is still there, then we'll go issue some credit cards. The other alternative is we're going to slice the salami. So we're going to set aside something like 10% of the engineering capacity for building our own authorizer payment processor over time. But they're only going to deliver marginal features. No feature looks like we're building a processor at any point in time, but maybe over 3 years or something you have a processor at the end of it because you're slicing the salami from both ends, from the company's side and the processor side. So that's what we actually ended up doing. So the team kept growing as a function of the engineering team size. In the meantime, we could actually validate that the company existed, so we could hire more people, raise more money, do all those things. And yeah, 3 years later, we actually had a payment processor with thousands of balance types and arbitrary interest rates that you can choose for testing and a bunch of other things.
Yeah. I mean, I call that building outside in,
Mhm.
like really focus on the stuff that touches customers, right? As opposed to calculating interest, which, is not really
Yeah.
differentiating.
Yeah. So there's an old song about this guy at a auto factory where he takes a part home with him, one part at a time, and 20 years later, he has a car at home.
I haven't heard that one. So, talk about slicing the salami on the credit side. So, how did you start underwriting? That first customer, the first hundreds of customers. Like I said, you're data driven, but you don't have data yet, or how did you get
Yeah.
data?
Yeah, that was interesting and challenging. So we had a plan for market entry and just table stakes, right? So credit cards were useful products for people, even if they did not need to borrow, just because they enabled certain types of payments like international flight tickets. Then Brazil had a little bit of a data infrastructure. So they had credit bureaus, some more sophisticated than others. One of them was Serasa, which was owned by Experian. We had a tie up with a MasterCard, which was the only, they took our phone call. So we were issuing MasterCard. Yeah, so we had to figure out how to enter this market and how to learn what we needed to learn. Because even if things don't work on aggregate, you might still have a subset of customers where your product is a great fit. So you needed to figure out the answer broadly enough. So the pitch was we're going to issue something like 1,000 credit cards over a couple of months. And we're just going to go down the credit bureau score. It might not be the best score in the world, but it's better than nothing. And the best 1,000 people, according to the credit bureau, can't be that bad. But if they are, we are willing to lose the money. So we already sized it and said we're going to issue credit limits in a certain range, and that means we are willing to take a loss of $1 million for a company that was capitalized at $2 million, and that's the cost of doing business. And we called it tuition. So that's the conversation we had with the board. So based on that, we said we're just going to manually evaluate everybody's credit score, do these cards, and then we're going to create some fairly sophisticated rules for figuring out identity theft and fraud even at that stage, because it could generate a bunch of intelligence by forcing everybody to go through the cell phone and forcing everybody to take a selfie and upload an ID and do a bunch of those things. And you could afford to do all those things because the app was very, very well designed. For the average Brazilian customer, the offer was you could go to a bank branch and wait 2 months, or you could go through this process for 2 minutes, even though we're asking you to take a selfie and do other things. And then we seeded a couple of PR articles about the launch of this company as a way to generate a little bit of buzz for people coming in and applying. And so that was another positive surprise, by the way. So we had a bunch of people go and apply. So that's a proof point on there is enough market demand out there for a product like this. PR articles actually did something. People bothered lifting a finger and responding to this. And so we had more people than the 1,000. So we could be more selective about who we issued those first 1,000 credit cards to.
Okay, so you get the first 1,000 just using the Sarasa score. That makes sense. What was the evolution then to, what we might call a mature credit policy? Like, what was the process there?
Yeah. So if you went the traditional way, you build your first model starting 3 years because you have 18 months of performance
Right.
that you need and etc. So we did not go the traditional way. Yeah, right off the get go, we had very competent data scientists. Some moved there from the US, some were Brazilian, people who were interested in the field, but who had no takers in terms of employers, who were doing things like competing on Kaggle and doing relatively well. We went and hired those people up. Yeah, so at every point in time, we said we're just going to figure out how far do our headlights go. So we have 3 months of data, which means we have some sense of first payment default. We don't know 18 months of performance, but we know first payment default, and we're going to make assessments about what subsequent performance looks like based on that first or second month performance. And we're going to figure out what we can tolerate or what our break even is, and therefore make decisions. For 5 years as a company, we had a growth meeting and a credit policy meeting every 2 weeks. In the beginning, you got 30% more data in 2 weeks.
Right.
And the challenge then was making sure that your data infrastructure and your people processes and your modeling techniques could actually respond quickly enough to that. Not something that took 3 months for you to build a model or 6 months, God forbid. That's how we started growing. The other advantage we had was credit limits could be modified. And so we validated this thing heavily enough, which was the minimum credit limit where a customer has utility was low enough that we could afford to issue low credit limits, take on a smaller risk in the beginning, but get customers, gather data, get them using the credit card, and then something like 20 to 30% of our customers got a credit limit of 150 US dollars.
Yeah. One of the things we did right at Capital One was the low and grow. We were really good at the low. For quite a while, we weren't really good at the grow. How did you guys kind of master the grow side of that equation? I mean, especially if you have an annual fee, right? The marginal return on the grow just can't be the same as what you have. You don't, the fee doesn't go up on that. You're just collecting interest on it.
Yeah, so we were not collecting much interest just because, for two reasons actually. So even at 20% interest rates, ours was much lower. I think we launched at 5.75%, which is 75% lower than the incumbents with their very attractive cost of funds. But the thing was, the company had enough demand that our constraint at any point in time in the beginning was just cash. And we would much rather get people who are transacting and paying their bills off every month than people who wanted to rotate a balance because, yes, economics were attractive, but we would still need to throttle growth because we need to come up with cash for all that lending. So mostly it was interchange, which is a swipe fee at the merchant for those new to this. Yeah, so we over time just looked at things. So we even encouraged some people to prepay. And then as we got good at figuring out initial credit risk, in the first few months, right, we would just say subsequent credit risk is just a fraction of it. You figure out the fraction and you can adjust it over time. And then over time, we got super complex with that, where a year in, we had models where we were looking at what type of purchases you are making, where you are making those, because every purchase came with a GPS coordinate, just with the app and everything. Where are you traveling? But also, the product was so successful, enough people wanted it once again because it was no cost to them, which was better than anything the incumbents had, that people were inviting other people. And so we could also use that information initially to figure out your credit risk. Who invited you and who are you inviting was informative as well.
That's some very interesting alternative data. Yeah, as I recall, the wait list grew pretty long. You were cash constrained. Were you also just constrained by, for lack of a better term, fear of just growing way too fast and things getting out of control?
Yeah, so that's why we had a growth meeting every 2 weeks because there's a variety of constraints at it. I remember one time we slowed down growth because the physical plastics for issuing credit cards at the factory were low. And so we had to back solve for how long would it take for them to get the right cards ready again. And therefore, what is the rate you are going to grow at between now and then? Yeah, so there's just several constraints at any given point in time. Ideally, you want the constraint to be something higher order, like knowing your credit risk, or you can't hire customer support fast enough because you're running out of space in the office and people are already cranky was also a thing.
So, were there any, I feel like in my experience, every new lender has probably two huge fraud attacks that they have to survive. Yeah, did you guys have any near death experiences, or were you living some kind of charmed life here?
So we didn't have any near-death experiences from fraud, but we had very interesting fraud. Nothing you see in the US.
Brazil's good.
Yeah. So we had, once again, none of these showstoppers, but the postman gets held up at gunpoint and his truck is stolen. And therefore, you have a certain number of outgoing mail in that specific truck going to that neighborhood, and all of them are stolen is a thing. There's some dentist office somewhere probably got broken into, and so you have a bunch of identities, the connected identities in the hands of an ID thief who wants to now use those is a thing. Those are examples. Yeah, so people trying to imitate you, calling customers, trying to divulge the pin and other information
Hmm.
about the card. That did happen. Yeah, and each of those we learn from. So eventually we got to such a good point that on a confirmed fraud or ID theft or a stolen physical card, our credit losses were under 20%. Sorry, our losses were under 20% because we just got really good at identifying the transaction patterns for fraud and just stopping them there. Yeah, we had other near death experiences for other reasons. Thankfully, not from fraud, as far as I know.
So let's talk about funding a little bit. Yeah, I mean, you went from, I guess that $2 million when you joined to $45 billion valuation at one point. What was the evolution of the raising of rounds? And yeah, can you talk about how, if you will, the first round was different from the fourth or fifth round?
Yeah, but it wasn't always up.
Okay.
David was really good at this. So he managed to keep the valuation going up, but the fundraising process itself wasn't always up. Yeah, so the initial round was 2 million raised at $10 million valuation. So something I wouldn't say I enjoyed was we were raising minimum once a year, every year for something like 7 or 8 years there. I mean, at some level, it's a good problem to have because all the fundraising was mostly going towards growth. And it was very cost efficient growth because we were also not spending much on customer acquisition. At the same time, you have to think about what percentage of your time you're spending in the fundraise cycle. And you could be the best at it, but it's still a distraction. It takes away from building the business. Particularly being in Brazil, every one of our funders for the first 7 years, if not longer, with one exception, was international. It was US based, which means you also had to travel to the US for fundraisers. We were thankful that in our seed round, we actually had Kazakh ventures. They were Brazilian Argentina based, but that was the only company. The environment back then was not mature enough for venture funding for a company like this locally. I think there are more options now.
Yeah. So how much of your time were you spending then? I get that it was frequent, and so it's some portion of your time when you're raising. Having flown to Brazil several times, it's a long flight. It's time zone friendly from the U.S., but it is not flight time friendly. Yeah. So how much time were you actually committing to this, and how distracting was that relative to kind of your day job and your every other week growth meeting?
Yeah, so that's the one thing that we didn't drop the growth meeting.
Okay.
The way startup life grows, particularly if you're, I mean, I guess it's true whether you're doing well or not, you are anyway on the edge of just about keeping it together. So anything that's a distraction from it takes away from it. So obviously fundraising is necessary, so it's not exactly a distraction, right? It's one of the most, having enough funds is one of the most important elements of having a company at all. But like each fundraise cycle, and some of them are longer than others, you would lose at least 2 to 3 weeks of full time and then maybe 1 or 2 weeks of 30% because of those. And yes, you're running the business, right? So the basic business as usual things you take care of. But anything higher order, any strategy work, it always takes a beating, right? Just after the fundraise, you have a bunch of new initiatives, and it's not because you have extra funds. It's only because you have the time and the bandwidth. And so for us, that was a somewhere between 8 to 12 months, sometimes sooner.
Yeah. So it strikes me that, Brazil, well, everybody we talk to who wants to invest in Latin America wants to invest in Brazil, Mexico, and Colombia at this point in time, the trifecta, if you will. What did people have to see or believe if you had US investors, roughly a decade ago? What did they have to believe about Brazil? Because kind of my storyline is all of a sudden new got it like a huge valuation. Everybody's like, oh my God, you can make money in Brazil. Obviously, the investors in New Bank were ahead of the curve on that. What did they see?
Yeah, so the first two rounds were led by Sequoia, and it was, as far as I could tell, it was solely on the people and the team because their Series A financing wasn't even for the company that eventually came together. Yeah, it was broadly financial services, but it was something drastically different. As I said, even the name was different. So they made a bet on the people and the team. It also helped that David Velez, our co-founder and CEO, was their Brazil partner back then. So at least they had some experience watching him in action for a couple of years before that. So that's the first couple of rounds, and then subsequent couple of rounds came together with the customer buzz. Right, we had this long wait list of customers for a product like credit cards, and people were talking about it. And so when people see the growth and the virality that most of our customers were not being paid for, it's not paid customer acquisition, whether through marketing or something else.
Right.
They were just coming because other people told them it's a great product. That's how those rounds came together. And then after that, it's product vision, unit level economics, so on and so forth. But the thing I would say is we would always look at the comps with other US based fintech companies. There was always a large Brazilian discount. So when you look at number of customers or gross revenue or anything like that, and you look at comps with other companies from the same vintages, right, firms type other companies, it was pretty clear that there was a Brazilian discount because not enough investors were interested in Brazil. So the investors who were willing to take a bet essentially separated from the herd, right? They were willing to say, yeah, we're willing to invest in New Bank. They got a nice discount for it, and obviously they made out really well for it at the end.
Got it. So, last thing on this, I just want to hit is you referenced interest rates. We've seen lenders are still charging anywhere from 5 to 20% a month. In Brazil, the inflation rate is only like 10. So it's not aligned with kind of the inflation rate at all, as it may have historically been. What allows that to continue to happen in Brazil? Why haven't rates kind of been brought down over time? Do you have a theory on that?
Well, one thing they have come down over time because we were talking 20% for the best customers to, I believe Nubank is much lower than that today for even average customers. So yeah, the range will always look large because there are some customers or people who are new to credit where the only profitable price point at which they could be lent to might be a larger number, and maybe hopefully it'll come down over time for those customers.
Yep.
But so my understanding is it has come down over time, but it is still higher than what you would expect in the US. And I think there's a few things there, right? So there's the natural interest rate in Brazil is higher. Funding mechanisms for lenders tighter in Brazil. I know that our initial debt facilities cost an arm and a leg, and some of them had to be denominated in US dollars. So you're also carrying that interest rate risk or the cost of the interest rate,
Hedge.
cost of the forex hedge in it. And then beyond that, there's a bunch of structural elements like data availability, just physical issues like if you're doing it in a store, then there's operational cost and a bunch of other things, and you need to pay for it somehow. Also, I think I would say at this point, credit card penetration is probably higher in Brazil than many other developing countries, which means at some level people are paying for the access because it is a useful product to have.
Yeah. Okay, so let's pivot a little bit. More recently, you started and then shut down Pebble Health. Can you talk us through, what you were thinking there, why you started it, and why you shut it down?
Yeah, so my next startup after New Bank, in between I advised a couple of companies, some of which you have heard of, was Pebble Health. And it's something that always bothered me that health insurance was quite expensive in the US. And particularly coming back from Brazil, I had to shop for individual insurance. And it's the sticker shock when you see the full price of it, not just your payroll deductions that your employer made available to you. So I started looking at what caused this. And there are several problems. It's a vast field, and there are several problems, including the lack of enough incentive to reduce prices for insurance carriers because of the medical loss ratio limits.
Yep.
So that is one aspect. It's a complex field and shopping is hard because it's hard to compare apples to apples when you're shopping. And that opaqueness always leads to higher costs, just like it did with the credit products in Brazil. And then there's also a decent amount of waste, fraud, and abuse on the care delivery and payment for care side of it. So our solution, and I worked with my co-founder Vinay on this, our solution for addressing this was Pebble Health. We wanted to tailor employer offered benefits. So we started with small and medium sized companies, particularly tech startups, where by self funding a portion or all of your employee benefits, you have the opportunity to offer them at a lower price point for you while giving more generous benefits to your employees. And we heavily used the usual culprits, right? Data, technology, new AI tools to bring this all together. That's how we started. Obviously, it's the same lesson as with new bank, right? Yeah, you can have this thesis, but until the rubber meets the road, you don't know if it works or not. The things you think your customers care about are the things they actually care about or not. You can talk to them all you want, but the buying decision is the buying decision. So we launched and we got some pretty clear, loud customer feedback on what makes the shopping decision go around in this field for a product like this. We tried to adjust for it, but eventually we realized that we could not build a venture capital efficient business and scale it with what we were doing. And we essentially made the decision to share that capital at some point because our investors did not fund us to go build a very successful small business, a nice dividend business. They expect venture returns, and that was the right thing to do.
Got it. All right. Well, let's take it home then on this. So you've done a very successful startup. You've done a not successful startup. What advice do you have for other organizations, other people who are looking at starting their own business? How do they decide whether they've got the right idea and how do they grow it?
How do you decide you have the right idea? You can only decide that after you do.
The market has to tell you.
The market has to tell you. Yeah, your mom won't tell you, your friend won't tell you. And your investors, despite their best intentions and support, still can't tell you. You could be very successful at raising, but that is not a measure of success. Your customers need to use your product and pay you for it. And you need to run the numbers and find that sustainable either today or in the near future. So, what advice would I have? I would just say, yeah, keep things simple. Focus is extremely important. Postpone any large decision or investment that is not absolutely critical that you don't need to make today. I don't mean that in the way of delay decisions. I mean that in the way of if you don't need to think about it, don't think about it and execute like crazy. The focus thing is important, right? Where Pebble is a good example where for you to be successful, you need to string together six things, all of which had some risk of failing. When you have six things together that have a 50% odds of failing, you can do the math on what the
Yeah, the
contingent
power of
probability there is.
compounding.
Yeah. And that was also with Nubank with processor and authorizer and all that. If you needed both to succeed, you suddenly reduce your odds of success by at least 50%, if not more. So yeah, keeping things simple is important. Narrow things down to one to two hypotheses, test the hell out of them, adjust if you need to, go from there.
Yeah, and it's great advice. Well, thank you for joining today. For everyone else, you can follow Ensemble X and Manoj Pinna, that's Pinna, on LinkedIn. You can also visit us at ensemblex.com. You can find the Ensemble X Exchange podcast on all major platforms. And thank you again, Manoj, for joining us today.
Thank you, Shawn.
And thank all of you for listening.